Okay, this is the second section of the first class meeting. Now is the time to start Mike says chapter 1. Here's our agenda for chapter 1. We'll begin with an introduction to public finance, then discuss the role of government in the economy. After that, we'll compare public and private finance, and then delve into the 10 reasons why understanding public budgets is crucial. We'll also look at fiscal policy and economic stabilization, public goods and services, market failures and government intervention, and the implication of privatizations. And finally, we will talk about financial stability. So let's get started. First, what exactly is public finance? In simple terms, it's the study of how governments manage their revenue, expenditures, and debt load. Public finance is vital because it helps ensure resources are allocated efficiently, income is redistributed fairly, and economic stability is maintained. Earlier, we mentioned three main objectives of public finance, and these are directly connected to why public finance is important and why study public finance and budgeting. Public finance and budgeting are essential for effective public administration. Unlike corporate finance, public finance focuses on resource allocation for public welfare. The budget is a political struggle, not only in terms of what amounts are allocated, but also in what the budget process itself will be. The public budget process is a socially negotiated process. Mike Sell argues that there are numerous reasons for students to find the study of public finance important and engaging, and that is the basis for the first section of chapter 1. The major topics in this textbook can be summarized as how the government spends money, how the government collects money, and how the government borrows money. Within those processes, many important details are covered, such as the necessity for transparency in budgeting and how to use the criteria for sound tax policy to judge tax policy trade-offs. Another major theme of the textbook is that the public sector is uniquely suited to produce services that the private sector cannot, such as the production of public goods, redistribution of income, and the stabilization of macroeconomic business cycle. Chapter 1 lays out the motivation for studying the facets of public finance. So government's financial decision and its impact are collective. What do you mean by collective? So collective decision making is government finance process is inherently made through a collective decision making and political process, and it is involved with value judgment, not a scientific decision solely. So these decisions affect community and society as a whole, not individuals. Government's budgetary and financial decisions create externalities and manage externalities, a broken link between benefit and cost. Government's financial decision and its impact are coercive So taxing power. The government raises revenues by law, not voluntary exchanges. So it's involved with accountability of the government as well. The differences between public finance and private finance. Okay, public finance focuses on promoting public welfare with decisions driven by public policy and funded by taxation. In contrast, private finance aims at maximizing profits with decisions driven by market forces and funded by private investments. While private finance is crucial for economic growth, public finance ensures that essential services and infrastructures are available to all, addressing needs that the private sector might overlook. We will explore 10 reasons why understanding public budgets and finances is crucial for public administrators. Public and private sector institutions have a lot in common. Both need to hire labor, often competing for labor in the same labor markets. For instance, a physician could work for a private health system or for the county health department. Likewise, the public and private sectors also purchase inputs like computers and motor vehicles in order to finance capital expansions. Both entities may borrow from the private sector, municipal bonds in the case of the public sector, and corporate debt or commercial paper in the private sector. Therefore, the way the public and private sectors do business looks a lot alike. Understanding public budgets is critical for several reasons. First, it helps with effective resource allocation, ensuring that funds are used where they are needed most. It also builds public trust and ensures accountability by making sure that government officials are responsible for how they spend public funds. Public budgets play a significant role in economic stability, helping to manage economic cycles through spending and taxation policies. They address public needs, promote efficient management of the public resources, ensure legal compliance, and enhance transparency. Long-term planning is facilitated through budgeting, leading to better administration and improved public services. Fiscal policy is a tool used by governments to manage economic cycles by adjusting government spending and taxation policies. The government can influence economic activity. For instance, during a recession, the government might increase spending or cut taxes to stimulate the economy. Conversely, during an economic boom, it might reduce spending or increase taxes to cool things down. These actions um, stabilize, help stabilize the economy, promoting steady growth and reducing the impact of economic shocks. Now, let's talk about the government role in the economy. Without the government legal system to guarantee property rights and enforce contracts, corporate organizations and market exchange would be virtually impossible. Anarchy and the free market are not synonymous. One of the main reasons governments intervene in the economy is to address market failures. A free market is assumed to lead to prices at which the amount sellers want to supply equals the amount buyers demand. Economize on the use of scarce resources and make people better off if markets are competitive and function smoothly. But market failures occur when the free market fails to allocate resources efficiently. For instance, public goods like national defense and street lighting are not non-excludable, and revilers, meaning everyone can benefit from them without reducing their availability to others. This characteristic makes it difficult for private markets to provide these goods. Common causes include externalities, public goods, and imperfect information. Or market failure occurs when the market does not operate through competition but is instead controlled by a monopoly. The government plays a critical role in economic stabilization and redistribution to address these failures. We will discuss real-world examples and engage in group activities to identify market failures and government interventions. Let's take a break.